it could definitely get to the point to where the gold and the guns are the things that are the only things that have value. We keep trying to. It just feels like we're trying to inflate our way out of this bubble, and if we inflate our way out of this bubble, that's going to be good for commodities. And nobody holds commodities.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, consumer confidence. Evidently, the consumers are a lot more confident than the economists, than the investors, than the politicians. What does the consumer know that we don't know? Our good friend Eddy Gifford is here now to give us some insight. So consumer confidence actually increased in February. What do they know?
Yeah, I mean, I don't think they know anything. I think that's the problem. That when you look at it over the last couple of months, like we're relatively flat. We've been in this kind of like sideways action going on if we're looking at it from a charting standpoint. But when you look like kind of deeper into the details, there's two components. There's what we call the present situation index, and there's what's called the expectations index. And the present situation, for whatever reason, consumers are just like, they're content. They're happy. I mean, the stock market's up this year. Maybe they're looking at their portfolios and they're like, oh, we see green, everything's good. But when you ask those same consumers the question of, hey, what do you think things are going to be like in 6 months, that the mood changes. We've seen that continuously get revised down. If you look at last month, the expectation was 76.3, and this month it's at 73.8. And so we're in a situation where anything under 80 typically says, hey, recession coming, and that thing is trending downward. And so I think that the consumer is just a little bit happy, a little euphoric, probably like everybody else, because we've had a good run up in the markets. And but as we've talked about on this show several times, Kerry, the bubbles feed themselves until they don't. And when they don't, it's very harsh. And we are in every definition of a bubble right now. So when that pops, you're going to just see consumer confidence get crushed. The interesting thing is it's hard to know what the overall reaction is going to be. Like we know that equities, stock market will get crushed in that scenario. What we don't know is how bonds will react, because generally speaking, it's always been, hey, things get really bad, just put your money in bonds and we'll go back up. But it appears that the Fed is more comfortable with higher inflation levels. And if we maintain higher inflation, that's going to potentially push interest rates up more, which is bad for bonds. So could this be like an everything collapse again, just like a 2X or 3X compared to 2022? Unfortunately, I think that is on the table. I don't want it to be, but I think it is.
Hey, so in the meantime, gold is it hit a new all-time high last week, broke $2,200. Bitcoin made a bunch of new highs. Now it's pulled back. It's only at 70,000. What are you making of those markets, their response to, as opposed to the consumer confidence number?
I think gold is always the one that you just have to pay attention to. And I think that gold is sending us a warning. It's been kind of, glowing, if you will, for the last couple months. And we kind of saw it kind of hit a breakout. It's kind of consolidating, and now we're seeing it start to trend up again. That's not good. When you look at intermarket relationships and you look at how things tend to react and everything, gold tends to be a leading indicator. And so if gold is running up, that means that there's probably something bad on the surface. So maybe the consumers do have it right from a 6-month standpoint. But I think the problem is we've been in such this fear of missing out, FOMO type investment mentality that everyone just keeps chasing. And I mean, I'm starting to get stock tips from my clients, which anytime that happens, that's when it starts to be like, wait a minute, I'm the advisor here. And so it's very important to start if you don't already use it, start implementing risk management now. because you can't do it after everything falls. You have to do it now. And gold is definitely telling us something. Bitcoin's a different one. Sometimes it acts like gold. Sometimes it acts like just a pure spec play. And I feel like it's been more speculative recently. Obviously we've got the spot ETFs that are live and active now. We've got the media and everyone's circling around the halving event that's going to happen next month. And we've got Michael Saylor at MicroStrategy borrowing money to buy more Bitcoin. It seems like every single week.
Yeah.
So, there's definitely, there may be some underlying value there, but there's definitely a little bit of a pump going on in that space. Doesn't mean you can't ride the wave, just means that you have to make sure that, again, risk management, you got to have your exits in place.
Okay, so looking at this, you really think that a collapse is imminent?
I don't know how we avoid a credit event. I mean, short of the Fed stepping in and lowering everything back to zero so that they have no type of obligation on the other side as far as like making interest payments on our debts. That's about the only thing I feel like they could do to kind of salvage anything short term. But the issue with that is that's just going to lead to higher, more rampant inflation, and that's just going to cause the consumer to collapse. And so I think that a credit, event is coming. I don't know if that's in 3 months or if that's in 18 months. I think that from a political standpoint, everyone would prefer for it to happen after the election, not before. It's way too easy to blame if it happens before. So I think that that's where we're at. There's just a lot of stuff under the surface that continues to flicker. We've seen a lot of like risk off type signaling, and then the next week everything's risk on again. And so like we're definitely like flickering back and forth between risk off, risk on, risk off, risk on. But I think that the telltale is what's going on with gold. And so if we continue to see gold rise, then we're going to see something. And when it happens, it's going to be very painful, unfortunately.
All right. So we're looking at this thing. Obviously, a credit event means a banking event, doesn't it?
Yes.
Mm-hmm.
And you look at
hundreds of banks that are literally hanging on by their fingernails now. And the last Fed address by Chairman Powell to Congress, he said, he kind of let it out there that there's a lot of banks that are going to be merged in and taken over and all this. You think it's going to spread to the major banks as well? The money center banks, as we used to call them?
It seems like it could. I mean, I don't know how greedy some of these bigger banks have been. Obviously, if a consolidation occurs and we see a lot of these regionals fold into these big banks, then absolutely it's going to spill over, because you can only have so much poison before everything is poisoned. And that's kind of what we're looking at. You look at the classic example is New York Community Bank. Last year they came to the rescue, and now it looks like they're going to be the next one to fall. So even though they've gotten private investment and help, that it looks that stock price just keeps trending downward. The regional bank ETF is not much higher than it was when it originally just got crushed last year at this time, and the Fed backstop is no longer in place for a lot of these banks. So if there is a consolidation and we do see the big banks absorbing these regional banks, I think that's going to spell trouble for some of these big banks. Maybe not the biggest, but you're still in a situation where that it looks like financials look good right now, technology looks good right now. Like they look good, but they look good until they don't. So you just got to make sure that you have some uncorrelated stuff in your portfolio. And you got to make sure that you've got stops in place to protect yourself when things go bad. All
right. So, hey, what about AI here? Is AI going to save us?
I mean, the media is telling us that, right? The AI is.
Oh, they're always right. The media, aren't they? Isn't the media always right?
So the issue with AI is that we're seeing it in a very one-dimensional phase right now. And what I mean by that is, if AI is truly going to be this extreme deflationary measure, then we should see that spilling over into interest rates and treasuries. We just see that spilling over into other assets, like small companies. And we just don't see that. If you look at the Russell 2000 as an example, the only reason it saved any face this year is because it had super microcomputers and MicroStrategy in it. If you take those two out, it's getting crushed this year. And a lot of these small and medium-sized companies still haven't even gotten close to their highs that they achieved in 2021. And so we are in this very, very concentrated market, and that typically always spells trouble.
Okay, so again, we go back here. So gold, guns, and God, huh? Is that basically what you're saying? Sure.
And it seems to be the theme every time that we talk, Kerry. It could definitely get to the point to where the gold and the guns are the things that are the only things that have value. We keep trying to. It just feels like we're trying to inflate our way out of this bubble, and if we inflate our way out of this bubble, that's going to be good for commodities. And nobody holds commodities. I mean, look at everyone has the S&P 500 sectors. No one owns commodities. I mean, cocoa. Oh my gosh, I don't know if you saw cocoa this week, but cocoa is like just exploded to the upside, and that's not good. That is telling us that more warnings. Gold and commodities are telling us inflation super cycle, and nobody wants to believe it.
Let's not forget our good friend and colleague, Dr. Copper, broke $4 again last week. I think it was last week, or maybe it was yesterday. Now it's trading slightly under, but it's been creeping up, and inflation is always going to rear its ugly head when it comes to copper, because, copper is it. That is the ultimate surrogate for the economy. Eddie, I'm kind of amused. You're a financial planner. I don't hear many financial planners telling their clients to put a portion of their holdings into precious metals and maybe some into cryptocurrencies, although that's changing now, and some into ballistic precious metals. You're kind of unusual in that regard, Eddie.
Well, we like to think we're different. I mean, I'm of the standpoint of I'm really big into portfolio construction, and it may sound weird, but if there's not red on the statement, you're not truly diversified. And so when we have the big years and like we did in technology, and we're 80% stock and 20% equity, precious metals, gold, whatever, that's okay, because we want some true insulation in the portfolio regardless of what the cause is. And bonds used to be that. They were that during the bond bull market that basically has happened over the last 30 years. Well, the bond bull market has been over for 2 years. And so you got to be looking at other things, whether that's commodities or, managed futures are a place that we like to look, because they typically are trending on commodities. Those are places that can really help save you if something bad really does happen. And the Bitcoin stuff, we've been watching that and testing that for over a year, and implemented that for clients this year. Get some of that into the portfolio just as a diversifier, and give you some significant upside potential. But also we like it when stuff goes up at different times, and most portfolios now are so correlated that markets are up, yay, we're winning. Markets are down, oh my gosh, it's not good. And we like to make sure that we're trying to balance that out. And the old school fixed income exposure just isn't doing it in this environment, and it won't do it if inflation continues to rear its ugly head.
Okay. All right, Eddie, very enlightening. Tell us where we find you.
Yeah, tacticwealth.com/Eddy-Gifford. You can always email me. I know that you have that too. It's just Eddy.Gifford@tacticwealth.com. Or just go ahead and jump on and Google Eddy Gifford, and I'm sure that you'll see not only this show that we're on today, but all the other ones that we've been on together. So,
well, better than that, we've got a link to your site in the show notes of this interview on financialsurvivalnetwork.com. And why don't you sign up for your free newsletter when you're on the site? And if you got a question for Eddie or myself, shoot me an email, kl@kerrylutz.com. Eddie, great catching up with you. We'll talk to you again real soon.
Appreciate it. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now more than ever.